How much of your portfolio do you allocate to Palantir?
40%.
Okay. That's what I was thinking based on what you were outlining there.
Mm-hmm.
And have you, that position, has it grown into 40%? Do you trim it all? Have you added? How's that worked over the last couple of years?
So the way it works is, so I own 40% Palantir, 40% S&P fund, and 20% Tesla. So I have only 3 positions in my portfolio. And I keep them at the same levels at all times. So whenever is, for example, when the stock is coming, one stock is coming down and the other one is coming up, so I'm dollar cost averaging more into the losing stock. And when the stock is coming down and the other one is going up, I'm always constantly rebalancing. So for example, in February 2025, when Palantir was coming down, so I was DCAing more into Palantir. Now, naturally, when Palantir is, at record highs still, I'm more in other stocks. So I'm always constantly balancing that 40-40-20 ratio. So whatever's going up, I'm buying less of. Whatever's coming down, I'm buying more of.
I think that's healthy to do it. It makes sense because you also are going against psychology, right? Psychology is like, we want to put more into the one that's going up, right?
Yeah.
But you're actually doing the opposite way, which typically does work out better from an odds perspective.
So here's the thing. So we know averages, right? They're really simple, but people forget there's such a thing called a weighted average, right? So if 3 and 4 and 3, you add it all up, you get a 10, right? You divide it by 3, it's a 3.33, right? Simple average, right? But what if I say that I'm going to give more weight to a certain part that's not the same as the other parts? At that point, that data point is going to pull harder towards itself, right? So if you continuously buy more when the stock is down and less when the stock is up, but you buy at all times, what you end up creating is a weighted average on your cost basis. And if you look back after 5 years, your cost base is going to be very, very close to the bottom. Not at the bottom, never at the bottom, but very, very close to the bottom without timing the market even once. Now, the only thing that can knock this out of efficiency is that if you pick the shitty stock. Now, if you pick the shitty stock, the system isn't going to help you because you're going to have a low cost basis in the shitty stock. But assuming you bought good companies and you've blended it with a large position in the broad market ETF, and you're continuously pushing the average down through constant buying and accelerating on the way down, decelerating on the way up, yes, you're beating your own bias by math. And because think about it this way. If you surround yourself with mainstream media, you're going to hear panic on the way down and euphoria on the way up. And if you go on social media, humans are going to do the same thing. And if you constantly watch the price and you zoom in, you're going to feel like you're in the spin cycle, right? So, because every day is basically like a crapshoot. So 54% of days are green, 46% are red in the market, historically. So every day it's a crapshoot. It's a 50-50 pretty much, right? So you're like a pinball machine. Like, if you zoom out for years, so 75% of years are positive in the stock market. And if you zoom out on decades, it's 95% of decades. And if you zoom out 20-year periods, so it's 100%. There was never a 20% period that was negative. So the more you are able to zoom out, which requires discipline, patience, and emotional fortitude, the longer you can really have your horizon, the easier the game becomes. It becomes a cheat code. So it's simple, but not easy because it requires discipline and it requires to fight your own impulses and urges, et cetera, et cetera. A lot like the fitness world we were talking about earlier.
Yeah, I would definitely agree with that. I think that you have to come to love it, right? It's kind of like going to the gym. You do it for long enough and you're like, this feels great, right? So if you can do that long enough with the stocks where you're actually bringing down your cost basis because you have confidence, but it's about, like you said, picking the right thing and having confidence.
Did you hear the reverse alcohol example about the long-term investing?
No, tell me.
So, alcohol feels good when you drink it, right? It's a dopamine rush. You feel great. And then like for a couple of weeks, you feel like shit. And long-term, it's really bad for you, right? So on the other hand, like long-term investing in real life, sometimes you feel like an idiot, right? So let's say a stock that you didn't buy like crazy and you only bought like, you DCA'd slowly and then it shot up like 600%. oh, it feels like an idiot, right? But long term, the more times go by, and the more you keep doing disciplined DCA, then it feels better and better and better and has a better effect on your portfolio. Versus daily trading feels great. Oh, I've made 10% today, mom. I've made 20% yesterday. Oh, this, and then you get crushed. And then you look back, oh my God, I spent 5 years basically trading water. Nothing really happened. Okay, so I did. Most of them don't even beat the S&P 500. That's the sad truth. Now, some of them actually make money. You know who makes money in trading, in my opinion? People who are willing to dedicate their life to it. They have a chance of making it happen. But the thing is, most of the people who want to trade have a job, have kids, have commitments. They can't, so they want to half-ass it, wing it, and they expect they can beat pros, which is a silly state. Would you go to a basketball game trying to beat a pro in basketball? It's silly. Why would you want to do that?
Yeah, I think people don't also realize that similar to basketball, it is a zero-sum game, right? Somebody wins, somebody loses.
Precisely.
On these trades.
Precisely. On every trade, and you know what they say, if you don't know who the sucker's on the trade, you're the sucker.
Yeah. If you don't know where the liquidity is coming from, it's you.
Yeah.
Yep, exactly. Question for you. So is there any chance that another stock could make its way into your portfolio, or is your position allocation locked in for 2026?
No, it's definitely possible. The one thing I'd like to think of myself as an open-minded person. So I'm always on the lookout for interesting opportunities. But I'm also very strongly built into my convictions, right? So if something comes along and it fits my criteria, it will be added. And if not, I'm not going to be adding anything just to feel like I have control because I'm active. So activity isn't control. It's the biggest misunderstanding in long-term investing. It's like when things, like, when the market goes bad for a few days, you know what they say, investing horizon strength, right? But what happens is, like, people psychologically feel like this feeling like they're in fight and flight, right? Fight or flight, this risk, something bad's happening. So they need to feel in control of the situation to feel better. So they buy and sell, or mainly sell, so they can feel some control. But it's just a fallacy because there's no real control in it. I think activity, again, not for traders, for long-term investors, the less you're doing with your portfolio, the more successful you're going to be. And studies actually prove this. There's a famous study that looked at, I think a couple decades of Vanguard or Fidelity users, and like top performers were, accounts in the state of dead people who are basically smashing everybody else.
Yeah, I remember that study. Basically, if you can hold long enough, you'll typically outperform.
Yeah.
Now, also, that was specifically because they were probably all allocated to, broad-based Vanguard indexes as well, right?
Yes. In every study, there's some sort of a bias, you know what I mean? But the principle remains. You probably want to be as less active as possible, the more bored as possible, and find your dopamine elsewhere, not in the stock market.
I think there's a Warren Buffett quote, I believe, where he says if everybody could only make 10 stock moves in their life, they'd all be rich, right?
Oh yeah, that's it. I never heard it.
Yeah.
Have you heard the Warren Buffett quote, the most famous one? It goes something like this: "I never said that shit."
Yeah. He did say, though, that the market is, what do you say? The market's a vehicle for or a tool for moving money from the impatient to the patient.
Yeah. There's a meme I saw. Somebody put it on a T-shirt, like a Warren Buffett picture, and they're like, "I never said that shit." I thought it was hilarious because there's so many quotes he never said and gets attributed to him. But the ones you mentioned, they are dope. Yeah, it is true. He also has this one of my favorites. Actually, not like I love Warren. Right. My favorite quote comes from he keeps telling the story. Somehow every time, it's still, even though I know the story, it's interesting. So it's the farm story. Have you heard him tell the farm story?
I don't think so.
So he's from Omaha, Nebraska, right? So it's always a farm story, right? So you buy a farm, right? And you buy a farm because, whatever corn bushels you can get out of it and whatnot, and you estimate, you buy it and you work it, et cetera, et cetera. And then your neighbor has an identical farm, the same one as you, like perfectly identical. And he's a psychopath. So every morning he knocks on the door and offers to buy your farm from you. Some mornings he's like in euphoria, so offer you crazy prices, and some mornings he'll offer you like half what you paid. It's like, would you feel stressed when he offers you half what you paid for your farm? You would say, no, he's a crazy maniacal psychopath. Why do I care? Like, it's my farm. It's like, if you can think of the stock market this way, it's going to make your life a lot easier.
Yeah, I think people mostly struggle here because they don't have deep conviction in the individual picks, right? It's easier, I think, to have deep conviction in the SP 500, in QQQ, right? You can look at very, very long track record in history, but your portfolio, 60% of your portfolio is in 2 individual positions. And these are positions that have a lot of volatility and also leadership that's very polarizing, right, as well within it. And so I think that it's tough for people sometimes.
And key man risk. Key man risk in Tesla and Palantir are the biggest. Yeah, massive. Insane.
But
probably the biggest in the market.
I would agree, but the hope is that they're not going anywhere, right? I think that they're